Hello to everyone. Today I am here with the educational topic that is stocks and their valuation on my channel Financial Reality. Stock and their valuation is a part of Business-1, and if you are interested to have update videos on academic topics, do subscribe my channel. Lecture-1, stocks and their valuation. What do you mean by the stocks? Stocks are the equity instruments, mean the part of capital employed by the owner. The total capital employed include two parts. First is capital equity and second one is capital debt. Capital debt is a part of the borrowing from different sources like from financial institutions, from family and friends, from associated companies, from directors, etc. Company float their stocks in the primary market as equity instrument, and thereafter these stocks trade in the stock exchange or stock market between the investors in their as a part of their secondary market at market price. The objective of this calculation is you should have aware what should be the in-string or the fair value of the stock before purchasing. One of the models in order to assess the stock in-string value is the growth model. The growth models are divided in three parts. First of all, the constant growth model. Stocks are valued based on their growth, on the dividend to be paid to the investor. Second one is the no growth model. Stocks are valued based on their is no expected growth on dividend to be paid to the investor. And third one is non-constant growth model. Stocks are valued based on the non-constant growth on dividend to be paid to the investor. Non-constant growth model, for certain period there is a growth of say 4%, and thereafter the growth rate may increase to 10% or may decrease to 1%. In this lecture, we are going to discuss the constant growth model. If the dividend, and I am going to explain this model with the example from the daily life. If the dividend at the time of investment means at the time of purchase of the stock is rupees 3, and the growth rate is 3%, calculate the instant present value of the stock and its value for 4 years. Considering the return on stock is 8%, it means over the period of the 5 years, there are chances that there will be a capital gain on the stock as well, because we have two types of the return, one in the shape of capital gain and second one in the shape of the dividend. Here what is given in the question, dividend D0, dividend at the time of the stock purchase is rupees 3, and there is a growth of 3%. Growth is represented by the G, and RS is 8%. Expected return on stock means it's the capital gain on the stock. Now what we have to find is present value of the stock at the time of purchase, after first year, after second year, third year, and the fourth year. The dividend at the time of purchase is 3. So it's growing by the 3%, and after first year, it will grow to 3.09. For the second year, it will grow to 3.18, and after third year, it will grow to 3.28. Then after 4 years, it will grow to 3.38, and after 5 years, it will grow to 3.48. Now you can see the formula here, and on the basis of this formula, do calculate these dividends on your copy to have the understanding about the topic. Now here we are going to calculate the value of the stock at the time of the purchase. P naught is equal to D naught 1 plus G divided by RS. RS is the expected capital gain minus growth. So D naught plus 1 plus G is equal to D1. We have the value of D1. We have also have the value of RS and of the growth. We have put these values. Here we have the value of D1. Here is the expected growth or the capital gain, and that will be minus with the dividend growth rate. So the answer comes to 61.80. It means the value of the stock at the time of purchase, if it is equal to 61.80, you should go for the investment. If it is not, you should not go. After the second year, we have D naught 1 plus G power 2. That is equal to D2. We have the value, we have already calculated the value of D2, RS minus G. On the basis of that, the value of the stock after 1 year should be equal to 63.60. So from time to time, you can verify your calculation with the actual values of the stocks in the market. In a similar way, you have calculated the value after 2 years, after 3 years, okay, after 4 years. Value of the stock here, it should be 4. And it was our final finding that we have to calculate for the 4 years. If you want to calculate the value straight away after 4 years, you have the formula. The formula is Pn. N can be 1, 2, 3, 4, 5, whatever it is. D naught 1 plus G N plus 1 and RS minus G. So here we have to calculate the value of the stock after 4 years, which we have also calculated here. So it will come to P4 D naught 1 plus G power 4 plus 1 RS minus G. Here we have calculated the value comes to the same value which we have calculated earlier. And if you want to calculate the value of stock after 10 years, so here you can simply place N, that is equal to 10, D naught 1 plus G, 10 plus 1, RS minus G. So the value after 10 years should be equal to 83.04. On the basis of that, you can also calculate the exact value of the capital gain as well. Thank you very much. See you again with the upcoming video on the same topic very soon.